We're less than 4 months away from 2026, and let me tell you, big changes are coming. Interest rates are likely to fall, housing could get even less affordable, artificial intelligence might take more jobs, and the stock market, it's shaping up to be a roller coaster. Some people are already panicking, others are overly optimistic, but the truth is, no one really knows for sure. What matters isn't predicting the future. What matters is preparing for it. On the passive path, we focus on exactly that, building wealth no matter what the economy throws at us. So today, we're going to talk about how you can protect yourself, invest wisely, and set up systems that work in 2026 and beyond. And here's the thing, you don't need a finance degree. You don't need a Wall Street connection. You just need a plan. If the stock market dropped by 50% tomorrow, what would you do? Would you panic sell and swear off investing forever? Or would you see it as a chance to buy in at a discount? You can't buy the dip if you don't understand the dip, and you can't invest confidently if your foundation is shaky. That's why the first step is simple. Be prepared. Building your financial base before you even think about investing, you need a cushion. I'm talking about a basic emergency savings fund. Start with $2,000, not $10,000, not $1 million, just $2,000. Why $2,000? Because it's enough to cover the most common surprise expenses without overwhelming you. Picture this, you're driving home and your car suddenly won't start. The mechanic tells you it's going to be $1,500 to fix it. If you don't have that money set aside, you're stuck. You either put it on a credit card or you're left without transportation. Or think about winter. Your furnace breaks in January. You can't just say, well, I'll wait a few weeks until payday. You need it fixed now. That $2,000 could be the difference between freezing or sleeping warm at night. And if you have kids, one trip to the emergency room for a broken arm can cost $1,000 or more, even with insurance. Without that cushion, you'd be digging yourself into debt. So the very first financial milestone is clear. Save that $2,000. Make it a non-negotiable. It's your foundation. Once you have that, the next step is to get rid of high-interest debt. If you're paying 25% interest on a credit card, and the stock market averages 8 to 10% a year, where should your money go? The answer is simple. Pay off the debt first. Think about it this way. If you carry a $10,000 balance on a credit card with 20% interest, you're losing $2,000 a year just in interest. That's like lighting $2,000 on fire every single year. Why would you invest hoping to make 10% while losing 20% at the same time? Once the high-interest debt is gone, you can finally start putting your money to work. And here's the big difference between wealthy people and broke people. Broke people make money, spend money, and hope there's something left to save. Wealthy people make money, save first, invest second, and then spend whatever is left. It's not about how much money you make. It's about what you do with it. If you make $10,000 a year, you start small. If you make $100,000 a year, you save and invest more. If you make $1 million a year, the numbers are bigger, but the rule is the same. Here's a simple system that anyone can follow. For every dollar you earn, spend 75 cents. Invest 15 cents. Save 10 cents. Let's say you make $4,000 a month. That means $3,000 goes to living expenses, $600 goes to investing, $400 goes into your savings. It's simple, it's automatic, and it forces you to build wealth without thinking about it. If you set up this system, you'll have a strong financial base. You won't be living in fear of your car breaking down. You won't feel forced to sell investments during a market crash. You'll be ready for what's next. And what's next is learning how to actually invest. Because having money set aside is only step one. The real question is, what do you... Now that you have your financial base set, it's time to move to the next step. Education. Not the kind of education that buries you in debt for a degree you never use. I'm talking about financial education. The kind that helps you actually understand how money works. Because here's the truth. Most people don't invest because they think it's too complicated. They hear terms like S&P 500, ETF, or capital gains and immediately shut down. But building wealth isn't about memorizing Wall Street jargon. It's about understanding the basics and building a system that works for you. Think of it this way. If you were driving across the country, you wouldn't just get in your car and hope you end up at your destination. You'd need a map, or at least a GPS. Your investing education is that map. Without it, you're just guessing. And guessing with money is dangerous. So where do you start? First, let's talk about passive investing. This is where you put your money into something like index funds or ETFs and let it grow over time. You don't have to check the stock market every morning. You don't have to be a financial wizard. Take the S&P 500, for example. It's simply a list of the 500 largest companies in the United States. When you invest in an ETF like SPY, you're basically buying a piece of all of them at once. That means you own a slice of Apple, Microsoft, Coca-Cola, and hundreds more. The beauty of this approach is that you don't have to guess which company will win. If one company struggles, another might thrive. Over time, the overall market has historically grown, even though it goes through ups and downs. Now, let's say you want to go even broader. You could look at VTI, which gives you ownership in thousands of companies across the entire US stock market. It's like buying a piece of the entire economy, or maybe you're more interested in technology companies. That's where an ETF like QQQ comes in. It gives you exposure to the biggest tech companies, Amazon, Google, Meta, and more. Of course, tech stocks tend to be more volatile. That means bigger gains when things are good, but also sharper drops when things go wrong. Here's a real-world example. Imagine two people, Alex and Jordan. Alex puts $300 a month into an S&P 500 index fund. Jordan buys individual stocks trying to find the next big winner. Over 10 years, Alex steadily builds a six-figure portfolio without stressing over daily stock prices. Jordan hits one or two winners, but also loses big on companies that crash. Who ends up with more money? Most of the time, it's Alex. That's why for many people, passive investing is the simplest, most effective path. It's not about outsmarting the market. It's about staying in the game long enough to benefit from it. But maybe you're the type who wants more control. That's where active investing comes in. This is when you research companies, read financial reports, and try to find undervalued opportunities before everyone else notices them. Let's say you're living in Seattle in the early. You notice Amazon is expanding, building new offices, hiring thousands of people, and slowly changing the city. If you invested then, you'd have seen massive growth over the next decade. But here's the catch. For every Amazon, there are dozens of companies that never take off. Active investing can work, but it requires time, patience, and the ability to stomach losses. It's not for everyone, and stocks aren't the only game in town. There's also real estate. Real estate investing can also be passive or active. If you want it to be hands-off, you could invest in something like a REIT, a real estate investment trust. It's like an ETF, but instead of stocks, you're buying a piece of real estate portfolios, apartments, shopping centers, warehouses. Or you could go the active route. That means buying a rental property yourself. You'll have more control and potentially higher returns. But it also comes with more responsibility, repairs, tenants, property management, and plenty of headaches. Here's a simple North American example. Imagine you buy a $250,000 duplex in Ohio. You rent out each unit for $1,200 a month. After paying the mortgage, taxes, and maintenance, you might walk away with $500 a month in cash flow. That's real money hitting your bank account every month, while the property itself grows in value over the years. The key with real estate is location. You can renovate the kitchen, you can repaint the walls, but you can't move the house to a better neighborhood. If people are moving into an area like Austin, Nashville, or Tampa, you're likely to see both rents and property values rise. The bigger picture is this: you don't have to do everything. You don't need to chase every trend. You just need to pick an investment style that matches your personality. If you want it simple, go passive with ETFs or REITs. If you enjoy research and risk, go active with stocks or real estate deals. What matters most is that you know what you're doing, because the fastest way to lose money is chasing hype, buying the stock everyone is talking about on Reddit, or jumping into crypto just because it's trending on Twitter. When you build real financial education, you see through the noise, you stop reacting, you start planning. So let me ask you this. Do you want to gamble your future on hype? Or do you want a strategy that builds wealth, whether markets go up, down, or sideways? Now that you understand the basics of investing, it's time to talk about something even more powerful: your strategy. Because knowledge without a system is like having a car with no gas. You know how it works. You know where you want to go. But without fuel, you're not moving anywhere. The wealthy don't just hope. They build systems that keep their money growing no matter what. That's what you need too. Here's the rule that can change your financial life. Always be buying every paycheck. A portion of your money should be automatically invested. Not when you feel like it. Not only when the news is good. Not only when your friend brags about a stock. Every week, every 2 weeks, every month, like clockwork. This is called consistency over timing. Most people try to time the market. They wait for the perfect moment. They watch charts, they wait for dips, and they second guess themselves. But here's the reality. Nobody can predict the market perfectly. If you look back at history, every decade has had a major recession or crash: the Great Depression, the oil crisis of the 70s, the dot-com bubble, the 2008 financial crisis, and even the 2020 pandemic crash. But here's the part most people forget. Every single time the market came back, not only did it come back, it came back stronger. If you had invested $1,000 in the S&P 500 in the 1980s through all the crashes and chaos, you'd have tens of its today, not because you picked the perfect stock, not because you timed the market, but because you kept buying no matter what. Now let's look at what happens when you don't have a system. Imagine you save up $5,000, get excited, and dump it all into the stock market one day. Then a month later, the market crashes 40%. You panic, you sell. You've now locked in your loss. But if you had been investing steadily, week after week, that crash would have been your chance. You'd be buying stocks at a discount. Think of it like shopping on Black Friday. You don't avoid the sale, you take advantage of it. Here's a practical example. Let's say you invest $500 every month for 10 years into an index fund that averages 8% annually. By the end of those 10 years, you'll have contributed, but because of compound growth, your account could be worth over $90,000. That's an extra $30,000 just from being consistent. Now imagine you stopped investing every time the news looked bad. You'd miss out on those discounted shares. And instead of buying low, you'd be waiting for things to feel safe, which usually means buying high. This is why systems matter more than emotions. Your emotions will always try to trick you. Your system will keep you on track. This is the third step of building wealth strategy. It's about setting rules for your money, so you don't rely on feelings or headlines to make decisions. Here's a quick breakdown of what your system could look like. Automatic transfers from checking to savings after every paycheck, automatic investments into a total stock market ETF every 2 weeks, a set percentage of income dedicated to long-term growth, a rule for downturns, keep buying or even increase buying when prices fall. Your goal isn't to time the market, it's to stay in the market long enough for compound growth to work in your favor. And when you combine preparation, education, and strategy, you're no longer reacting to the market, you're controlling your future. So the question becomes this: what if you want to go beyond the basics? What if you want to not just follow the market, but actually spot opportunities before everyone else? That's where we go next. If you've made it this far, you already know how to save. You know how to clear debt. You know how to set up a system to keep investing. But what if you want to take it further? What if you want to go beyond just riding the market and actually position yourself ahead of the curve? That's where active investing and advanced strategies come into play. Active investing is not for everyone. It takes time, energy, and patience. It's not just about buying stocks randomly. It's about researching, understanding trends, and spotting opportunities before the headlines catch on. Let's talk about studying market shifts. This is the skill wealthy investors rely on. They're not fortune tellers. They're students of money. They look at where capital is flowing. They study government policy. They follow consumer behavior. They ask, where is the world moving? Take the housing market. Over the past decade, people have been moving out of high-cost cities like San Francisco and New York. Why? Because housing costs became unbearable and remote work opened up new options. Where did they go? Places like Austin, Dallas, Miami, and Nashville. What happened there? Rents went up, home prices surged. Investors who saw that shift early made a fortune. Now think about technology. Back in the 2000s, people thought the internet bubble had popped for good. But out of that chaos came companies like Google, Amazon, and Facebook. Today, people are saying the same thing about artificial intelligence. Some say it's a bubble. Others say it's the biggest opportunity of our lifetime. The truth? It's probably both. There will be winners and losers. The key is knowing how to tell them apart. So how do you build an active investing strategy? Start with industries, not stocks. Ask yourself, which industries are growing no matter what? For example, renewable energy, healthcare, cybersecurity, and AI. Look for migration of money. Are businesses and people moving into certain states? Is government spending increasing in certain sectors? Follow the flow of money, study the data. Don't just read headlines. Look at company earnings reports. Track debt levels. Pay attention to who's actually making profits, not just who's getting media hype. Be patient. Even great companies take time to grow. Amazon took over a decade to really explode. If you expect overnight riches, you'll get frustrated and sell too soon. Active investing is like running your own business. It's exciting, but it's also risky. If you get it right, you can beat the average investor. If you get it wrong, you can lose big. That's why many people choose real estate as their active play. With real estate, you have something physical, a house, an apartment building, a piece of land. Let's imagine you buy a small duplex in Pittsburgh for $220,000. You rent out each side for $1,000 a month. Your mortgage, taxes, and maintenance total about $1,500. That leaves you with $500 in profit every month. Over 10 years, that's $60,000 in cash flow, not even counting appreciation. Now, here's where real estate gets interesting. If the neighborhood grows, if new businesses open nearby, if more people move in, your property value goes up. The rent you can charge also goes up. And unlike the stock market, where you're just an observer, in real estate, you can actively improve your property. You can remodel a kitchen, you can add a bedroom, you can refinance for better terms. Yes, it takes effort. Yes, it requires management. But the rewards can be life-changing. This is why so many millionaires in North America hold real estate. Not because it's glamorous, not because it's quick money, but because it builds wealth steadily with both cash flow and appreciation. So here's the bottom line. Passive investing grows your wealth quietly in the background. Active investing can accelerate your growth if you're willing to put in the work, and real estate gives you both passive and active options. The question you need to ask yourself is this: do you want to keep it simple, or do you want to dig deeper and go active? Because the next step is all about what's coming in 2026. And trust me, you'll want to be ready. Now let's talk about what's coming in 2026. Because the future isn't going to be calm. It's going to be unpredictable. Interest rates are likely to drop. At first, that sounds like good news. Lower interest rates mean cheaper borrowing. Mortgages might get more affordable on paper. Car loans might look more attractive. Businesses might find it easier to borrow money to expand. But here's the other side. When money gets cheaper, people start borrowing more of it. That pushes prices higher. And if housing is already expensive, easier credit can make it even harder for regular people to buy a home. Think about what happened in the early 2000s. Low interest rates after the dot-com crash made mortgages cheaper. That led to a housing boom. But by 2008, the bubble burst. Home values collapsed, banks panicked, and millions of Americans lost their houses. Now fast forward to today. If rates fall again in 2026, we could see a similar scenario. Cheap debt fueling another wave of inflated prices. Great if you already own assets, tough if you're still trying to get in. But that's not the only storm on the horizon. Artificial intelligence is shaking up jobs everywhere, from customer support to trucking, to marketing, to coding. The jobs of tomorrow won't look like the jobs of today. Some people will lose income. Some careers will vanish. At the same time, new opportunities will open up. Companies will need people who can manage, guide, and work alongside AI. But if you don't prepare, you risk being left behind. And then there's the stock market. Volatility is not going anywhere. We could see a boom, we could see a crash, or we could bounce sideways for years. That uncertainty is exactly why your strategy matters. If you're relying on predictions, you're vulnerable. If you're relying on systems, you're secure. So what can you do right now to prepare for 2026? Step 1, build your financial cushion. Step 2, eliminate high-interest debt. Step 3, learn your investment options and create your system. But there's more. You also need to prepare for the bigger economic shifts. Ask yourself these questions. If housing gets more expensive, what's my plan? If AI changes my job, what skills am I building now? If the stock market crashes, do I have the mindset to keep investing? The future doesn't reward the people who wait for certainty. It rewards the people who prepare for chaos. In 2025, we've already seen turbulence, and 2026 is likely to bring even more. But turbulence doesn't have to be a threat. It can be an opening. It can be the exact moment when ordinary people build extraordinary wealth. The real winners aren't the ones who avoid the storm. They're the ones who know how to sail through it. So here's the question. How do you build income streams that keep paying you, even if the world turns upside down? That's what we'll cover next. Let's talk about something that can completely change the way you live. Passive income. It's one of the most talked about topics online, but here's the problem. Most of what you see about passive income is wrong. You've probably seen people promising that you can make money in your sleep by doing nothing. Buy this course, download this app, start a side hustle today, and never work again. That's not how real wealth works. Real passive income takes effort up front. It takes planning, and it takes discipline. But here's the good news. Once you set it up, it keeps working for you. It's not overnight money. It's long-term freedom. So what does real passive income look like? There are three main types. First, dividends from investment. When you buy stocks in strong companies or index funds, some of them pay you a portion of their profits. That's called a dividend. For example, if you own shares of a company like Coca-Cola, you get paid a small amount for each share, just for being an owner. It's not huge at first, maybe a few dollars every quarter, but as you keep buying and reinvesting, those dividends compound. Second, rental income from real estate. If you own a property and rent it out, that cash flow can cover your bills month after month. Imagine you own a small single-family home in Ohio. The tenant pays you $1,200 each month. After mortgage and expenses, you keep that's $3,600 a year, and over time, the property could grow in value too. Third, royalties or digital assets. This could be writing an ebook, creating a course, licensing photos, or even earning ad revenue from YouTube videos. For example, a YouTube channel like The Passive Path can keep earning money from videos posted months or even years ago. That's not instant wealth, but it's income that keeps flowing after the work is done. Now here's the truth. Building enough passive income to live off of takes time. If you want to replace a $50,000 salary, you might need $500,000 to $1 million invested, depending on your strategy. That doesn't happen in a year. But here's what most people miss. You don't need to wait until you're wealthy to start. You can begin small. Even $10 invested each week adds up. Even one side project that makes you a couple hundred a month can change your life. Let me give you a relatable example. Sarah works at a hospital in Chicago. She started writing guides about her nursing experience on the side. At first, it made nothing. But after a year, she started selling a $15 ebook for nursing students. Now she makes an extra $500 a month, and she's still a full-time nurse. That $500 pays her car payment. That's passive income. Or take Mike in Texas. He works in IT but bought a duplex. He lives in one unit and rents out the other. That rent covers his mortgage, so he's living for free. That's passive income too. See the pattern? It's not about getting rich quick. It's about building small streams that grow over time. Eventually, those streams can cover your lifestyle. And when they do, you're no longer working because you have to. You're working because you want to. So let me ask you this. What would your life look like if your bills were already paid before you even got out of bed? Because the last step is about putting everything together into a simple action plan. You can start today. Now it's time to put everything together: preparation, education, strategy. These are not just concepts. They are steps you can follow starting today. Here's your action plan. Step 1. Build your first $2,000 in emergency savings. That's your cushion. That's your safety net. It's not optional. It's your foundation. Step 2. Eliminate high-interest debt. If you're paying 20% to a credit card company, you're losing money faster than you can invest it. Wipe out that debt first. It's one of the best returns you'll ever get. Step 3. Apply the 75-15-10 rule. Spend no more than 75 cents of every dollar you make. Invest 15 cents. Save 10 cents. Set it up to happen automatically, so you don't have to think about it. Step 4. Choose your investment path. Do you want to be a passive investor and let index funds do the work? Do you want to be an active investor studying businesses and searching for opportunities? Do you want to own real estate and create monthly cash flow? Pick the lane that matches your interests and personality. Step 5. Commit to always be buying. Whether the market goes up, down, or sideways, you stay consistent. When everyone else is panicking, you're collecting assets at a discount. That's how wealth is built. And here's the final piece. Stay flexible. The world is changing fast. Interest rates will shift. AI will change the job market. The stock market will keep swinging. You can't control any of it, but you can control how prepared you are. You can control your knowledge, and you can control your system. That's what wealth building really is. It's not luck. It's not timing. It's not secret insider knowledge. It's preparation meeting opportunity. So here's what I want you to do today. Start with that $2,000. Pay off your credit cards. Set up your 75-15-10 system. Pick your investment style and stick with it, because here's the truth. Chaos creates opportunity, Every crash in history has made people rich. The question is, will you be ready to take advantage of the next one? The passive path is here to guide you. We're building wealth step by step. We're doing it in a way that's simple, practical, and designed to last. So if you found value in this, hit like, subscribe to the Passive Path for more videos that help you master money and create freedom. And drop a comment below what's your strategy for 2026. The future is coming fast. You can panic like everyone else, or you can prepare, stay consistent, and let your money work for you. The choice is yours.